welcome back to the Deep Dive. For many of you, the journey into sound money starts with that very visceral moment, right? Acquiring your first ounce of physical silver.
Oh, absolutely.
You hold it, you feel that weight in your hand, and you just know you've secured a piece of real, undebased wealth.
And that's the foundation. That is Silver 101. It is absolutely the necessary first step.
But today, we're moving past the introductory course. This is an advanced class, really. It's custom-tailored for you, specifically in capital optimization during a precious metal supercycle.
That's the perfect way to frame it. If that initial step buying the physical is about playing defense, buying the insurance, making sure you survive the generational reset.
Right.
Our mission today, based on this fascinating stack of source material, is all about understanding how to play offense. We're looking at very specific strategies to maximize your physical ounce count during the most explosive, most volatile part of the coming bull run.
Okay, so let's unpack this core dilemma right from the start, because the sources frame this difference between two types of investors perfectly. The question is, do you want to be safe or do you want to be rich?
And they are defining two profoundly different approaches to handling your metals when prices are moving, parabolically.
It's a huge distinction.
It really is. What's truly fascinating here is this recognition that the philosophy of just stacking and holding, the purity of it, the physical accumulation, it's noble, it's essential, but it is ultimately the slowest way to build wealth in a hyperinflationary mania-type environment.
So what's the alternative?
The goal for the active accumulator today is to master what we're calling the Silver Multiplier strategy. The traditional way, it relies on your steady income buying a steady number of ounces each month.
Sure, the slow and steady approach.
Right. The multiplier strategy, on the other hand, uses volatility and leverage, specifically high-liquidity paper assets, to capture these potentially explosive 200, even 300% growth spikes on a portion of your capital. And then, and this is the key, immediately and mechanically rotating those harvested profits back into your foundational physical metal.
So we're not just redefining the approach, we're redefining the tools.
Yeah.
We're setting you up with a new goal. Using the highly leveraged stock market, not as a permanent home for your money, but as a strategic tool.
A temporary cash harvesting machine.
Exactly.
Precisely. And to really get a handle on this, we have to define the players in this ecosystem. First, we have the, let's call him the lazy stacker. This is sort of the default position for most people.
And there's nothing wrong with that, to be clear.
Nothing at all. This person fundamentally believes in sound money. They religiously buy a Silver Eagle or maybe a 10-ounce bar every single month, put it in the safe, and they just wait. And that approach, it's the insurance policy, it is foundational, it's necessary, and it provides incredible peace of mind.
But then we introduce the other player, the active accumulator, the smart money player we want you to become.
The active accumulator operates under a crucial and I think often overlooked premise, which is that when a silver supercycle really hits, holding physical metal is the slowest way to make money on your capital. The appreciation is just linear, right? It goes up with the spot price.
One for one.
One for one. The active accumulator recognizes the need for a turbocharger. They choose to strategically trade the paper waves, the volatility of the stock market, specifically to build their ultimate physical fortress faster than their job income or steady savings could ever allow. They see the market as a resource. It's a resource to be exploited for the ultimate goal.
I like that framing. It's the difference between, say, relying on your salary to buy bricks one by one to build your house, versus finding and operating a faster, more efficient brick-making machine with that same initial capital.
And then using the output of that machine to build a house.
Right. It's all about capital efficiency and acceleration in an environment where speed really, really matters. The sources suggest that if you don't play offense during a mania, you are leaving, potentially massive generational wealth just sitting on the table.
And that wealth, it doesn't just evaporate, it goes straight into the pockets of the middlemen, which brings us to our first major roadblock.
So let's get into it, the friction problem.
Right, the friction problem.
Now, we need to address the fundamental flaw in trying to use your physical metal for this kind of strategic accumulation during a bull run. The sources call it the friction problem. If physical silver is the ultimate non-counterparty risk endgame asset, why should we ever stop buying it and instead use paper assets to get more of it? It seems counterintuitive.
It does on the surface. But it's because physical metal, while it offers this unparalleled security for the end game, it is fatally flawed as a trading vehicle.
A trading vehicle.
The reason is simple mechanics that just crush your potential profit. Transactional cost. This cost, which the sources term the premium trap, is the hidden tax you pay. It's eaten up by the dealers, the wholesalers, the middlemen, and it utterly destroys your profit potential during rapid price swings because you lose too much on the way in and you lose too much on the way out.
Okay, let's get specific. Let's detail the mechanism of that loss. We need to be crystal clear on the math here, because this detail is what illuminates the inefficiency for the lazy stacker who might try to trade their physical stack.
Okay, let's use the specific, really straightforward example from the source materials. Assume a starting point where spot silver is sitting at, say, $30 an ounce.
Okay, 30 bucks.
Due to logistical costs, manufacturing, the dealer's need for a margin to run their business, you are inevitably going to pay a premium over that spot price. So in this scenario, let's say you pay $35 to buy a specific Silver Eagle or a 10-ounce bar.
Right there, you're $5 in the hole.
Immediately. You are in the hole by $5, which is 16.7% of the spot price, before the trade has even begun. You've already lost the first leg of the race.
So you've sacrificed the first $5 of any upside movement just to possess the physical object. Now, okay, the market starts moving. The bull run is on. Maybe it's driven by industrial demand news, global fear, whatever. Spot silver jumps, and it jumps quickly from $30 up to $40.
A huge move.
A huge generational $10 move in the underlying asset. If you were trading a, let's say, a zero-friction paper asset, you just made $10. That's a 33% gain on the spot price. Simple.
But you're holding physical. You decide, okay, I've made enough profit. I want to lock in these gains, and you go back to the dealer. The dealer now needs to protect their own margin. They have to hedge their own risk. This is the bid-ask spread kicking in.
They're not going to pay you $40.
Never. They won't pay you the $40 spot price. They might only pay you, say, $38 for that same piece of bullion you just bought them.
So, okay, let's trace the profit line on that whole physical transaction.
Yeah.
You initially paid $35.
Yep.
You sold it for $38. Your total captured profit is $3.
And this is the painful nugget of knowledge we really have to share. On that massive $10 underlying spot price move, a move of 33%, you, the investor, only captured $3 of profit.
Wow.
You captured just 30% of the market movement. The other 70% was swallowed entirely by the friction inherent in the transaction.
So the initial premium you paid, and then the dealer spread you accepted on the sale.
The combination of the two just wiped out most of the move.
Okay, wait. I want to challenge that, because this is a common objection I hear from listeners. A lazy stacker might argue, look, the reason I buy physical is to avoid counterparty risk, and that peace of mind is worth the $7 I just sacrificed to the dealer. How do we address that trade-off?
That is a crucial question. And that counterparty risk argument is 100% valid for your core stack, for your battleship, which we will define later. But when you are actively trying to multiply your ounces, that $7 loss per ounce is actually a missed opportunity to buy more insurance.
Wow, okay.
Over the course of a mania where prices might surge and crash multiple times, that 70% transactional loss just multiplies. You're sacrificing immense potential accumulation by subsidizing the middleman's operation every single time you attempt to trade. The smart money says, keep the physical for the insurance, but use a low-friction tool for the multiplication process.
And that inefficiency, I'm guessing, it only gets worse when the market goes truly irrational. The sources talk about this mania scenario where liquidity itself becomes a terrifying issue.
Oh, absolutely. I mean, just think about the logistics. If silver hits $100 an ounce and you decide to lock in a life-changing gain, say you've got 1,000 ounces, which is now worth $100,000, you can click sell on a screen in a fraction of a second. You cannot physically liquidate 1,000 ounces in a fraction of a second. It's impossible.
I remember the panic buying in early 2020. Shipping times were delayed for weeks, premiums spiked astronomically, and dealers were just overwhelmed. Some of them even paused buying altogether for a while.
Exactly. The difficulty and the expense of securely shipping, handling, and ensuring a significant amount of physical metal during that kind of market chaos is immense. Furthermore, when demand goes parabolic, the dealers themselves, who have to manage immense risk and physical security, they might widen that bid-ask spread even further to protect themselves.
So the 30% capture rate we calculated.
That might drop to 15 or 20%. You are stuck. You're holding an asset that is difficult and costly to move precisely at the moment when you need maximum speed and agility. This recognition that physical metal has these inherent limitations as a high-speed trading tool, that's the empowering lesson of this section.
This brings us perfectly to the analogy we need to carry through the rest of this conversation. This is the difference between the speedboat and the battleship.
Exactly. Physical silver is the battleship. It is undeniably heavy, it's slow, and it's designed for safety, for stability, and for endurance. It is the endgame fortress built to weather any storm.
What?
But that safety comes at the cost of massive friction. It's constantly carrying that crushing backpack labeled premiums and spreads. It is wildly inefficient for capturing rapid market movements,
It's the ultimate vehicle for defense.
but completely inefficient for offense. What we need, what the active accumulator needs, is a speedboat. A vehicle designed specifically for high speed, for virtually zero friction, and for instant liquidity. A tool that can perfectly ride the spot price waves without sacrificing 70% of the movement to those transactional costs. The selection of the speedboat is what allows the active accumulator to execute the multiplier strategy.
Okay, so that's the problem defined. Let's talk about the tools, the arsenal of offense.
So we turn to the arsenal of offense, our speedboat tools. We need vehicles that give us maximum low-friction exposure to the silver price movement without requiring the physical handling of the object itself.
And tool number one is the liquid proxy. The sources put enormous focus on the Sprott Physical Silver Trust, ticker PSLV. Walk us through why they isolate this specific trust as the necessary speedboat, especially when there are, much bigger ETFs out there.
This is such a crucial distinction, and it really separates the smart money from the novice investor in this space. PSLV is critical because it avoids the fundamental structural flaw that's inherent in the massive competitor ETF, SLV, which we and the sources have consistently labeled the trap.
Let's just briefly remind everyone why SLV carries that label, even if we've touched on it before, because its structure is really antithetical to the active accumulator's mission here.
Absolutely. The structural issue with SLV is that the underlying metal is often held in an unallocated state. Now, what that means is the custodian bank holds the metal, but the investors hold just a fractional claim against the bank's total pool. This exposes them to significant counterparty risk.
The very thing you're trying to avoid by buying silver.
The very thing. It exposes you to potential rehypothecation, which is where the underlying metal might be loaned out multiple times, and dilution risk during times of high stress. For the active accumulator, who is trying to avoid financial system risk by owning silver, SLV places them right back into the financial system's most vulnerable points. It makes no sense.
So SLV is basically the antithesis of sound money principles, even if it happens to track the price on a good day.
Precisely. PSLV, in contrast, is structured to hold allocated physical metal. It's audited, and it's held outside the commercial banking system in the Royal Canadian Mint. So while it trades like a stock, which gives you the functional liquidity you need, it retains that fundamental safety requirement of the underlying asset being allocated metal.
Okay, so you get the essential safety of owning allocated metal held securely, but you also get the functional liquidity of a stock. That's the core difference.
And the benefit, therefore, is its low-friction trading. PSLV offers instantaneous buy and sell capability. You execute with the click of a button. And crucially, the spreads are measured in pennies, and the overall transaction cost, including any brokerage commissions, is minimal.
So you're capturing almost all of the move.
It allows you, the investor, to capture 98 or 99% of the price movement, instead of that disastrous 30% we calculated with physical bullion trading. PSLV is the pure, low-friction vehicle for riding the spot price.
Okay, so that's the speedboat. It captures the market movement efficiently, but just riding the spot price won't achieve the multiplier effect, that 2x or 3x growth goal. To generate the windfall cash, we need the turbocharger.
Exactly.
That brings us to tool number 2. Mining stocks.
This is where we shift from low-friction tracking to high-octane risk. We are talking about the producers, the companies that are literally digging the metal out of the ground. These are aggressive tools because they possess what's called operational leverage, which acts like a massive turbocharger on the spot price movements.
We introduced the concept earlier, but let's go deeper here. Why does the stock price move so much more violently than the metal price? I mean, why does a company built on silver outperform the silver itself?
It fundamentally boils down to fixed costs and the elasticity of profit margins. Let's re-examine that model from a miner's perspective. Imagine a miner has calculated its total fixed cost to extract 1 ounce of silver labor machinery, power, permits, everything, at a hard $25 per ounce.
Okay, so that's their all-in sustaining costs.
Right. Now, when silver is trading at $30, their profit margin is $5 per ounce.
A modest but, manageable $5 margin.
Now, let's go back to our spot price example. Silver spot moves from $30 up to $35. That's a 16.7% move in the underlying asset.
Right.
Critically, the miners' fixed costs for extraction, they remain at $25. So their new profit margin is 35 minus 25, a $10 profit margin per ounce.
The profit margin just doubled,
Right.
a 100% increase, while the underlying asset only moved up 16.7%.
Exactly. This is operational leverage in action. The stock market, which is constantly pricing in future earnings potential, reacts dramatically to this doubling of profitability. This is why, when silver moves 16.7%, the miner's stock price might jump 30, 40, or even 50%, depending on the specific company.
The market is instantly pricing in higher revenue, higher net income, and potentially higher future dividends. All of that gets baked into the stock price very, very quickly.
Very quick.
But wait, let me ask this. If the profit margin doubled, a 100% gain, why did the stock only go up, say, 40% in your example?
Yeah.
What are the factors that sort of temper that operational leverage?
That's a very sophisticated observation, and it's a great question. If the stock doubled every single time the profit doubled, well, everyone would only own miners. The temperance comes from external factors. You have corporate taxes that kick in at higher rates. You have rising capital expenditures, or CapEx, to expand the mine or explore for new reserves.
Even political risk.
And huge political risk, which gets priced into the stock immediately. So while the profit margin per ounce doubled, the company still has hundreds of other variables that dampen the ultimate movement of the share price. But even with all those dampers, the leverage is still immense.
And that immense leverage is what the sources call the beta advantage.
And that beta is what we are hunting for. Historically, in a full-blown bull run, a silver supercycle like we saw from 2008 to 2011, the sources confirm that well-positioned, leveraged junior and mid-tier miners often outperform the metal itself by 2x or even 3x. If physical silver goes up 100%, a quality miner, especially a development stage one, might deliver 250 or 300% returns.
That volatility is the engine. It's designed specifically to take that relatively small 20% allocation of capital we mentioned and turn it into the windfall profits needed to rapidly expand the physical core stack.
You're using the casino's chips to buy the real estate.
That's a perfect way to put it, which brings us to the playbook itself.
Now we assemble the three pieces: the battleship, the physical for safety, the speedboat, PSLV, for frictionless tracking, and the turbocharger, the miners, for leverage. This is the smart money maneuver.
And I think the mindset here is just vital. We are not marrying the miners for the long term.
Absolutely not.
We are dating them. Our relationship is purely transactional.
It's the perfect analogy. The active accumulator's goal is to use them specifically to harvest fiat currency, to generate the cash that can then be immediately converted into real assets. We have to constantly reiterate the central focus here. Your ultimate goal is not to have more dollars showing on your brokerage screen. Your goal is to have more ounces of silver in your hand.
This is the critical separation, isn't it? The stock market is just a tool, not the goal. It is, as the sources articulate it, the casino where you win the chips to buy the real money.
Precisely. And this entire strategy requires the disciplined, almost robotic mechanical execution of the four-phase cycle.
Okay, let's walk through it. Phase 1, the run-up. This is the easy part, right? This is the fun part where everyone feels like a genius.
Right. The foundation of the cycle begins when the silver spot price rises, driven by whatever catalyst, inflation, industrial demand, central bank policy. Because of their operational leverage, the mining stocks, your turbocharger allocation, they just explode higher. Your brokerage account swells, the paper gains start looking exponential.
And the temptation is to just sit back and admire your genius.
Exactly. But that temptation leads us directly into phase 2, the exaggeration. This is the difficult psychological moment that signals the short-term top of the cycle, and it separates the active accumulator from the temporary gambler.
So what does the exaggeration look like?
The exaggeration phase happens when the market goes from rational enthusiasm to outright euphoria and mania. Everyone is talking about silver stocks. Your neighbor, your barber. The news reports are parabolic, the charts are vertical, they're defying gravity. You start seeing these massive gap ups in the morning. This excessive enthusiasm is the signal that the asset class is overbought in the short term and that the risk of a sharp correction is imminent. Your paper gains are maximized and the window to harvest is opening.
This frothiness is the signal. It's the time to execute phase 3, the harvest.
Yeah.
And this takes immense discipline because you are selling what is currently your beta-performing asset. It feels wrong.
It feels completely wrong, but you must execute the sale according to your preset targets. You liquidate the mining stocks that provided the leverage. You click sell on a portion of your PSLV position, which gave you that low-friction ride on the spot price. Those expanded, leveraged paper gains are immediately crystallized into fiat currency, sitting in your account as ready cash. This is the moment you transform potential profit into realized profit.
Okay, so if you miss phase 3, if the greed is just too great, you ride the asset all the way back down, potentially losing years of potential accumulation. But assuming you execute this crucial step perfectly, we move to phase 4, the rotation.
And this is the entire reason the maneuver was executed in the first place. You take that significantly expanded pile of cash and you immediately go to the bullion dealer. The active accumulator is not buying metal during the frothy phase 2 when dealer premiums are at their absolute maximum and, liquidity is crashing.
You're buying during phase 4.
They're buying during phase 4, ideally when the spot price may have dipped slightly following that mania correction, or, and this is critical, when the dealer premiums have compressed a little because that initial wave of panic buying has subsided.
So you're maximizing your purchasing power on both sides of the trade.
That's it. You use the high beta paper assets to generate the cash, and then you time the physical buy when premiums are temporarily softer.
Let's illustrate the final success here. Let's walk through the multiplier result with some numbers.
Okay, let's consider this hypothetical outcome based on the strategy. Let's say you started the cycle with $10,000 in your turbo allocation, so in the miners.
Okay, 10 grand.
Through the combined leverage of the miners and the low friction of PSLV, you successfully turned that $10,000 in capital into $25,000 in cash during the harvest phase 3.
150% gain.
Right. Now, if silver is trading around, say, $35 an ounce, which includes the dealer premium on the buy side in phase 4, your original $10,000 could have afforded you about 285 ounces. But now, with your harvested 25,000, you can back up the metaphorical truck and buy roughly 714 ounces.
Wow. That is an increase of 429 ounces. You literally achieved a 150% increase in your foundational physical stack just by trading the volatility in the paper market.
And a lazy stacker who started with that same $10,000 in physical would still only have 285 ounces. That gap, that 429-ounce difference, that is the engine of the multiplier strategy.
The system is designed not just to appreciate, but to accelerate accumulation beyond what slow, steady saving or linear spot appreciation can ever accomplish.
It uses the market's own inefficiency and volatility against itself.
Okay, we've laid out a powerful systematic strategy, but the sources are also very, very clear on this. A perfect plan is worthless without perfect execution. This brings us to the massive catch, the point where the human element typically destroys the system.
The greed trap.
The greed trap.
Yeah, this section is the behavioral finance class within the deep dive, and it is arguably the most important one for your success. When mining stocks are parabolic, when they've doubled or tripled, and every single day brings a new 5 or 10% gain, greed kicks in at a cellular level.
It's a physiological response.
It is. The investor, the human being, will rationalize holding them forever. The internal monologue is always the same. This trajectory is guaranteed. They are going to the moon. If I sell now, I'm leaving too much money on the table.
I can speak to that feeling directly. During the last major cycle, I remember holding a junior miner that went from $2 a share to $10.
Mm-hmm.
Every morning I'd wake up and it was another 10% higher. I had a clear target to sell half at $8. But when it blew past that and hit 10, the euphoria made me think, if I just hold another week, I can buy a house.
Right.
And that greed, it just paralyzed the sell button. And 2 weeks later, the stock was back at $6 and the house money just vanished. That paralysis is real.
That paralysis is the profit killer. It's what transforms a strategic accumulator into a gambler. You forget the inherent nature of the asset you're holding. The sources remind us that the profit from that $2 to $10 move is only real once it is physically rotated into metal. Miners are just corporate paper assets, and they are exposed to layers of risk that a physical bar in a safe does not face.
Okay, what specific corporate risks are we talking about here that differentiate a miner from a physical asset. Let's detail why the turbocharger is inherently unstable.
We can categorize them into three major threats. First, there's the geopolitical risk of nationalization or expropriation. Many of the most profitable mines are in, let's say, politically unstable jurisdictions. A hostile government, seeing these high profits, can seize the assets of the mine with the stroke of a pen, destroying shareholder value overnight.
Your bar of silver, held domestically, is largely immune to that.
Largely immune. So even if the spot price of silver is going to $100, the stock can still go to zero because of a political action. Absolutely. Second, there are operational disasters. This includes catastrophic events like a major mine collapse, a massive flood, a sudden regulatory shutdown due to environmental issues, or significant equipment failure. Any one of these can stop production cold, ruin the company's balance sheet, and send the stock into a free fall regardless of the spot price.
And then finally, there's a risk that management itself controls: share dilution.
This is the silent killer of shareholder value. Management can issue more stock, often to fund expansion or cover capital expenditure overruns, instantly watering down the value of your shares. This is especially true for junior miners. You can be 100% right about the price of silver, but if the management is constantly diluting the share count, your per-share value diminishes significantly.
Physical metal has none of these dangers.
By definition, none of them.
So if you fail to execute phase 3, the harvest, the failure of rotation happens, and you're now exposed to all three of these corporate risks while sitting on paper profits that are highly temporary.
If you forget to sell the paper and buy the metal, you are merely gambling. You're gambling that the correction won't happen until you eventually get around to the rotation. If the market corrects sharply, and corrections during periods of mania are always brutal, often 40 to 50% in a matter of weeks, your 300% paper gain can turn into a 50% gain overnight.
And the physical ounces you wanted to buy are now significantly less affordable, potentially making the entire maneuver a net zero gain, or even worse.
The profit is only real once it is a physical bar in your hand.
That has to be the mantra.
Until that rotation is executed, the entire windfall is, as the sources put it, just pixels on a screen. They are digital entries in a brokerage account, subject to digital risk, corporate risk, and instantaneous devaluation. They are not permanent assets.
So how does the active accumulator overcome this massive psychological difficulty? How do we build the systems to conquer that trembling human hand that's driven by euphoria and greed?
The smart money rule is to replace emotion with system. We have to make the process mechanical and boring. You need to pre-commit. This means setting clear, predetermined targets long before the mania hits, preferably when you are buying the initial stock.
Okay, so give us some specific practical tools for that robotic execution. It's not enough to just say, be disciplined. What structure helps you enforce that discipline?
First, use a scaling out approach. Never try to sell all of it at once at the very top. Your mechanical rule should be something like, when this stock doubles, I will sell 1/3 and immediately allocate that profit to physical. When it doubles again from there, I sell the next third.
So you take the pressure off.
You take the pressure off yourself by recognizing you will never catch the absolute top, but you guarantee that you lock in substantial gains along the way. Even if the last third goes to zero, you've already secured the profit from the first 2/3.
That makes sense. What's the second tool?
Second, use limit orders. If the stock is trading at $15 and your target is 20, don't wait for your gut feeling on the day it hits 20. Place a GTC good till canceled limit order to sell a specified quantity at $20. The computer executes the trade based on your pre-commitment, not your emotional state in the moment of euphoria.
It's an immediate, self-imposed profit-taking mechanism designed to defeat your own human nature.
It's automation overriding human weakness. You are constantly de-risking the aggressive position and compounding the conservative one. That is the core of the multiplier strategy. Use the volatility to generate cash and use the cash to secure permanence.
Okay, so this brings us to the final piece of the puzzle. How do we structure all of this, the verdict?
Having established the need for this dynamic rotation and the inherent risks of the paper assets, we can now look at how the multiplier portfolio should be structured. This blend is engineered to offer safety, liquidity, and aggressive growth, ensuring the leverage gains flow continuously into the physical foundation.
And this is a sample allocation, right? It's a blueprint for dynamic accumulation, but it provides the perfect structure for how the volatility should interact with the foundation.
We advocate for a 5-2-30-20 split, noting, as always, that every investor's risk profile varies. But this specific distribution is designed to maximize the potential of the multiplier strategy while maintaining a robust safety net.
Let's start with the anchor, the foundational core, the 50% allocation.
50% core stack, physical bullion. This is your battleship. It is defined entirely as insurance, a store of generational value. This portion is never sold. It's held for the generational reset, the ultimate safety net. It sits in the dark, out of the financial system, providing the non-counterparty risk security that drew you to silver in the first place.
So you treat this metal like a generational inheritance, not a tradable asset.
Exactly. Even if the price of silver tanks 50%, this half of your portfolio is still performing its primary mission, which is the preservation of purchasing power against fiat debasement. Its job is defense.
Okay. Next, we have the speedboat, the liquid allocation designed to track spot perfectly.
30% liquid proxy, PSLV. This is defined as the primary swing trade vehicle. It offers perfect correlation to the silver spot price, allowing for high speed, low friction entry and exit. It is the efficient way to bet on the price of silver itself. A key advantage of allocating 30% here is that it gives you massive liquidity. Crucially, it offers the ability to exit in seconds if the overall market trend breaks, protecting your capital instantly in a way physical metal just cannot when panic hits.
What about the drag of management fees on this 30% allocation? Since it's a trust, it does incur costs.
And that's the trade-off for liquidity and safety. PSLV does charge a management fee, which acts as a slight drag on performance over long periods. However, for the active accumulator who's engaging in this multiplier strategy, the gains harvested from the major price swings, combined with the immense reduction in transactional friction, they far outweigh the small expense ratio. We're using this as a midterm trade vehicle, not a 30-year vault.
Makes sense. And finally, the engine, the turbo allocation, the 20% that does the heavy, high-risk lifting.
20% turbo miners and leveraged assets. This is defined as pure beta, the operational leverage. This is the engine for generating the windfall, the 2x or 3x gains needed to significantly expand the overall foundational stack. It is the highest risk, highest reward component, and it must be kept to 20% precisely because of the immense downside risk we detailed in Section 4.
So if one of these stocks goes to zero due to nationalization,
You only lose 20% of your total strategic capital. But if they hit 300% gains, the result revolutionizes the size of your 50% core stack.
okay, so the genius of this strategy really lies in the dynamic flow of value between these three categories. It's not a static pie chart where you just check the boxes once a year.
Exactly. The portfolio is dynamically designed so that the aggressive gain generated by the 20% turbo asset is continuously harvested and fed into the 50% core asset. When that 20% allocation successfully triples, you don't just keep that profit sitting in cash. You peel off a specified chunk, and you use that to grow the 50% physical stack.
This means the active accumulator is constantly turning volatile, high-risk exposure into permanent, zero counterparty risk foundational wealth.
This is how you squeeze every ounce of value out of the bull run. The lazy stacker ends the bull run with the ounces they paid for with their savings alone. The active accumulator ends the bull run with a substantially larger pile because they successfully used the volatile market itself to aggressively fund their ultimate foundational savings goal. They made the market work for them.
This deep dive has really been a masterclass in treating the financial market not as a religious belief system to be worshipped, but as a strategic tool to be exploited. The coming silver mania will undoubtedly create millionaires, but the sources make it clear that the biggest winners will be those who abandon the slow, defensive stance of the lazy stacker and embrace the systematic offense of the active accumulator harnessing leverage and maximizing liquidity.
And the required action sequence, it's simple in concept, but it's very demanding in execution. Use the paper assets strategically. Set your robotic, pre-committed sell targets. Take the profit when the system tells you to, not when your greedy gut tells you to hold on for more. Buy the physical metal, rinse, repeat, and aggressively accumulate the physical fortress.
That willingness to sell volatile paper assets at the top, knowing that the real prize is the hard asset, is what ultimately separates the truly wealthy who execute a plan from the temporary gamblers who just ride the wave up and down.
And if we connect this to the bigger picture of wealth generation versus insurance, it raises a really important and necessary question for you, the listener, to mull over. We have established that physical is for insurance, your ultimate safety net. But miners and liquid proxies are for wealth generation and rapid accumulation. So, Are you currently positioned merely to survive the coming market squeeze, resting only on your safe, steady accumulation?
Or are you positioned with the 50-30-20 allocation to profit maximally from it?
The future belongs to the owners of true assets. And more specifically, the future belongs to the owners who understand how to transform those temporary, volatile, leveraged paper gains into tangible, foundational, and permanent physical assets. That is the smart money wisdom that drives the Silver Multiplier.